What I'll do is I'll just briefly touch on our management team, tell you our strategy surrounding what we think we're at the makings of a zinc market, as Eric alluded to, and then I'll just touch on some economics of our ore body, which is located in Queensland, Australia. So my background is on the mining finance side. I've been in the industry for 20 years. I've raised the last cycle, which I consider from 2004 to 2010, I raised approximately $150 million for various mining deals. As Eric mentioned, I was a founder and the chairman of Underworld Resources. What I particularly like about Underworld was we raised $29 million, put $25 million of that into the ground, and we sold it to Kinross Gold 36 months later for approximately $140 million. And they say the toughest thing in sports is to hit a major league fastball. I think the toughest thing in mining is to monetize an asset, and fortunately our team was able to do that. So following the Underworld sale, I put Vendetta together. I was agnostic when it came to the metal. In a perfect world, we ranked it gold, copper, and zinc. The difference was it was very tough to find quality copper and gold projects at the time, and I saw a unique opportunity unfolding in zinc, which I'll get to in a second. But my business partner in Vendetta, Peter Valgaris, who leads the technical team, is a mining engineer and geologist. Peter started his career in Australia for the Mount Isa mining company, located about 200 kilometers from our current ore body. And then he went over to Osborne, which is 25 kilometers away, where he made a discovery that they recently mined out. And then he went to work for Newmont at their giant Cali ore body in Western Australia. He then became the technical services manager at Oyu Tolgoi for Robert Friedland at Ivanhoe for 5 years, and then 2 years in business development. Ostensibly, he did the underground development on that giant copper porphyry. He sank the shafts. He worked with a gentleman by the name of David Baker, who sits on our board also. David is a chartered accountant for Ivanhoe. He organized $4 billion of debt financing, and he's been the CFO of several prominent Australian mining companies. Both David and Peter are based out of Vancouver. We recently announced the addition of our board to Doug Flegg. Doug Flegg is the former head of institutional sales for the Bank of Montreal. In his 10-year career there, he was involved in approximately 200 mining deals, and I believe the total amount raised was $25 billion. Doug Ramshaw is a geologist and a former analyst, and is involved in the day-to-day running of the company. Share structure, we currently have 72 million outstanding, 128 on a fully diluted basis. Management's position is 12%. We have several key institutional shareholders that have become strategic. Resource Capital Fund out of Perth, Australia, and Denver. They currently hold 28% of the company, and Solitario Mining recently participated in our last round of financing and took a 10% interest. They're a New York Stock Exchange and Toronto Stock Exchange listed company. Over the last 60 days, 40 trading days, we've traded approximately 20 million shares, roughly 500,000 shares per day. That's largely as we've turned our original shareholder base over from retail. We're now adding some new institutional holders who are participating through the market. And a lot of that stock was, we did a 5-cent round in May, and it became free trading in September. So that's the volume you're seeing, and there is additional institutional interest. Between management and institutions, we're probably at around 60%, with 40% being in float. Zinc. This last year has been the best performer with lead. The key thing with zinc, though, I use the analogy, it's akin to holding a burning match. There's been 2 zinc cycles in my career. They burn brightly, but they don't burn for a very long time. And as a company, I think that the key is when they are burning brightly and you do have those high zinc prices, which I believe, and I think Eric believes, we are should see maybe beginning as soon as 2017. You have to either enter into your M&A activity to get a significant premium for your company, or you raise your capital needed to put it into production at reasonable levels. So that the key from our corporate point of view is we think we have to be at the PEA level at that point. Now, the goal is in 2017 to put $4.5 million into the ground and get to that level. Now, the PEA level, pardon me. The thing with zinc, what's a little different this time than those two previous cycles, which I think were demand-driven, I think this cycle is supply-driven. In the last 2 years, we've lost the Lachine lead zinc in Ireland, Century in Australia, and the Perseverance and Brunswick in Canada. That's akin to 12 to 14% of world zinc supply gone. Those mines are out of ore. If I use a copper example, it would be like, what would be the big ore bodies? Grasberg, and then the ore coming out of Freeport-McMoRan coming off the market, or BHP and Freeport-McMoRan shutting their copper assets because they've run out. That's 12%. And you've seen what happens when you have a threat of a strike at a copper mine that has 2 to 3% of the world copper supply, prices go up. That's what we're going to see in the zinc. And the canary in the coal mine for me is what we call the treatment charges and refining costs at the smelter level. And in the last year, they've come off 40 and in some cases 50%. So it's an indicator that we're closer to a lot higher zinc prices. But as a company, we modeled, I looked at over 50 zinc projects. This is the one they picked because of the infrastructure. So the key thing modeling it moving forward, we use 90-cent lead, 95-cent zinc. We're currently looking today at $1.10 zinc and close to a dollar lead. So I think you have to be conservative on how you model it, because zinc will go up. Don Lindsay at Teck said it best. He said, we're going to wake up shortly and see $1.20 zinc, and then the next day it's going to be $1.50. Everything will start to go parabolic, but then you'll get some higher cost zinc producers, predominantly in China, coming in, and it'll eventually get pushed back, but it could get pushed back fairly quickly. I think we'll end up with a higher sustainable price of zinc, but that's where it's key. We have to demonstrate we can make our economics work at today's prices or even a little bit less, and hopefully we'll have a higher sustainable moving forward. So the evolution of our Pegmont project, it was originally discovered by Placer Dome in 1970. The key tenet here was it was thought to be a lead dominant system with a single lens. Now, we had a different theory on that, and I'll get into that in a little bit of a second. And then Placer brought in Newmont and Mount Isa and BHP to joint venture it. They were looking for a world-class ore body. They were looking for another Broken Hill-style lead zinc deposit. And when I say world-class, the definition would be top 10 percentile grade, top 10 percentile size. They never found it. They drilled largely close to surface, but they found approximately 5 million tons of sulfide ore grading 9% lead zinc. Now, to put it in historical context, in Australia, they were putting mines into production in the early 70s of 15 to 20% lead zinc. So a 9% lead zinc at the time would have been down on the curve. By today's standards, I think 9% lead zinc is considered good. And when you marry it with infrastructure, which we have at Pegmont, it certainly impacts your economics favorably. So it was then in 1995, a local Australian public company on an obscure exchange picked it up. They were focusing on the near surface zinc oxide mineralization. In base metals, and especially lead zinc, we don't want to find oxides. They're difficult to process. We don't get paid for as much. We want to focus on the sulfides, which we currently, so whenever I talk numbers, I'm just referring to the sulfide grade and the ore. So we picked up the project in 2014. We optioned it from Pegmont. We did a 43-101. In fact, there was 5.2 million tons of sulfide ore, grading 9.3% lead zinc. Since then, we've done 13,500 meters of drilling. That hasn't been included in an updated resource, which we should have out by January, February of next year. We also discovered a second lens to the ore body, so our thesis was correct as we went down dip, and the zinc grade increased. And there's a geological reason I can get into later. I'll be at my booth if I can explain that at that point. So everything started to line up as we expected it, and 9% grade is now considered good for that area. So the advantage is we are in Queensland, Australia, top tier mining jurisdiction. Infrastructure's fabulous. We're 25 kilometers from roads. We've got power within 20 kilometers. We're 44 kilometers away from a rail facility that would take us to the port or to Korea Zinc's Sun Metals smelter at Townsville. So at the end of the rail line, we have a lead zinc smelter 200 kilometers away by rail. We have another smelter at Mount Isa for lead. So, and then we could go on a deep sea port to Townsville and go south if we wanted to 2 smelters there. So there's 4 smelters in Australia that we could access. And probably most importantly, there's 2 mines close by that have a need, in our opinion, for feed, and we could use one of their mills. I don't think this region really needs a 3rd concentrator or mill. So. Permitting. One of the things in our industry, and I think most of the people here would agree with me, the last 15 to 20 years, if somebody says to you, we don't have permitting problems, we always have permitting problems in the industry. The question now is, are they manageable problems? And fortuitously here, Queensland's a very pro-mining government. Just to give you an example of how fast things happen, the Dugald mine, it's probably the next significant zinc deposit to come on stream. It's owned by MMG, the giant Chinese producer. And their CapEx is $1.5 billion. And they had that permitted start to finish in 24 months. We're fortunate because some of our claims are on what the Americans would call patented, or Canadians private land. So our permitting could be anywhere on the area that we think we can open pit to 6 months, with the rest being sort of 18 to 24 months. We have an open pit portion of the ore body. One of the key things, I think, if we are going to sell this or to demonstrate its economics, our goal internally is through the open pit portion, we want to demonstrate that we can provide 2 years payback on the acquisition and the capital costs associated with it through the open pit portion. And later when we're at PEA, I think we'll be able to do that. And then the rest of the drilling we're doing is what we call resource development drilling. We're drilling between known intersections, and that we can then bring that into our resource category moving forward. The deposit's completely open, down dip along strike, multiple regional targets. We've chosen to demonstrate to the market that it's economically as quickly as we can, rather than to expand the size. I think the global overall size is about 25 million tons, and I'll just quickly get into some of the economics. I talked about the infrastructure. You can see how close we are to the coast and the rail line. A good example of this would be either Timmins in Canada, Sudbury, United States, would be the Battle Mountain district in Nevada. It's in the heart of mining country. You know, if to use an arcane reference, if it were a baseball team, the infrastructure would be the New York Yankees. If it would be a football team, it'd be the New England Patriots. If it was a hockey team, it wouldn't be the Vancouver Canucks. So now I had that forward-looking statement at the front for a reason. We currently sit in National Instrument 43-101, 4.4 million tons, 9.3% lead zinc, 700,000 tons indicated, and the other is inferred. That plus the drilling, plus we'll have the metallurgy. We will have a new resource calculation out. I expect that to be ready in Q1 of 2017. But for the people that are more familiar with gold than zinc, just to give you an idea on gross metal value, the current 5 million tons equates to approximately, it would be an 800,000 ounce gold deposit grading 5 grams per ton. I think we're going to add, this is a guess, probably increase our resource by say 50%, so we'll have 7.5 million tons. That, if it was a gold deposit, would be about 1.2 million ounces, once again, grading 5 grams per ton. And then our scoping internal numbers show in order to make this ore body economic, we need to be at about 12 to 15 million tons, and then we'd be mining on our best 10 million. At that point, I think the producers in the region, those 2 other companies that I mentioned, which was Cannington and Osborne, would have a need for our concentrates, and we could demonstrate the economic viability. But that's akin to having a sort of a 2.5 million ounce gold deposit, once again grading 5 grams per ton. So just in summary, I think we're in the beginnings of a bullish lead zinc market. We've got great infrastructure. We've got an updated mineral resource coming that I think will give us a re-rating. We also have a new copper discovery on the project. PEA will be preliminary economic assessment, Q1 of 2018. We might try fast track it depending on how things go next year and how the markets are. We've identified multiple exit strategies, and we're sitting with a current market capitalization of $8 million. So I think there's some good opportunities ahead, and there's going to be quite a bit of news as we move the company forward. And fortuitously, I think we'll be in a zinc market. Thank you very much.